Strategist note that I've had in front of me speaks about, the January note speaks about the year of the all-rounder. Well, it'll be interesting to dive into the specifics of this in conjunction with what the recent notes or the earlier notes have stated, and what does 2024 essentially hold in store with our two guests, the authors of the note, Ashish Shanker, Nitin Shanbhag. Gentlemen, both of you, thanks so much for taking the time out. Well, it's too late to wish you guys a happy new year, but nevertheless, we hope that it's a happy 2024 by and large, because we've completed the first month and it's kind of gone ahead without too many accidents, but for fund flows out of India and some other EMs. But what do you mean essentially? What's the crux of this note, which is titled as Year of the All-Rounder?
Right. Thanks, Niraj. Happy to be speaking to your viewers first time in this calendar year. As you know, these notes are basically, they set the tone for our clients and investors. Generally, the January note sets the tone for the year, right? So when we say that this is the year of the all-rounder, it sets the tone for how clients should allocate their money across different asset classes. Now, if you remember, we had given a very aggressive buy call on equities after the state elections occurred, and we said that, people who are waiting on the sidelines should go in. And that call has worked fine so far, because equity markets have been buoyant in spite of FII selling. Now, when we did the investment committee meeting in December and looked at all the data, a few things struck us. First, from an equity market point of view, when we looked at Nifty or large cap, whilst relatively we may be expensive compared to global markets, but from an India context, we were reasonably valued, and earnings have been extremely good so far over the last 3 years. This will be the fourth year of double-digit earnings growth, FY24. Now, if I look at the broader market, mid and small caps, we did have this conversation last time. Although the valuations are a bit rich, but I think the underlying earnings growth is extremely strong. And as far as that continues, I don't see a challenge there. What is the remarkable thing is the resilience of domestic investor flows. I mean, every month you're adding about 25-30 lakh demat accounts, so new investors are coming into the stock markets directly. Plus, you're seeing the SIP flows go up every month on month. Hence, when this kind of FII selling happens, you still do not see too much of downside or a very large amount of volatility, because a lot of the selling is being absorbed by domestic investors. Having said that, valuations are not necessarily very compelling or extremely cheap. So we believe that this year, again, from an equity standpoint, should be good, considering the way India is looking in terms of economy, in terms of flows, in terms of the certainty on the elections. I mean, it's never over till it's over, but at least there is reasonable degree of certainty. We had also given a positive call on debt, if you recollect, Niraj, early on last year, because we said that at least we don't know when the interest rates will get cut, but we believe that we have seen the peak rates. So as a result, we had told most of our clients and your viewers that they should buy long duration funds in debt, or buy long duration bonds. We also hold a positive view on gold at the moment, given what is happening around the world and the fact that interest rates are probably going to head lower later this year, if not earlier. Gold as an asset class, considering all the geopolitical issues that are surrounding us and the currency issues that we are witnessing, I think gold is definitely a great asset class to have. So when we looked at it in entirety, Niraj, we didn't find any asset class which looked really negative, and it's quite refreshing to see this kind of a setup. Hence, we said that this year actually you will be good if you stick to your core asset allocation. So if as an investor you are saying you want to be 40 equities, 40 debt, maybe 20 gold, then you should not be overboard on any asset class. You should just stick to your asset allocation. And hence we said that this is the year of an all-rounder. I mean, in this year you have to go in with the team with more all-rounders, so that depending on the pitch and depending on the circumstances, you are able to deploy multiple forces to ensure that you come out on top.
Okay, if you lose early wickets, then at least there are some others to take guard later on. But Nitin, in some sense, so by the way, on gold, I think you guys were constructive maybe in May last year as well, if I'm not wrong. That note had spoken about gold too. But here's my question. From a call of being unequivocally bullish on equities to saying it's a year of all-rounders. So yes, all asset classes look good, but does it mean that equities don't look as good relative to others as they were looking maybe in December or earlier?
Yeah, so let's break up the entire equity basket into market caps so that your viewers kind of get an understanding of where valuations are. From a large cap perspective, we are reasonably valued. If you look at the 1 year forward price to earnings multiple, we are at about 20 times, and that is in line with the long-term 10-year average for the Nifty, right? The mid and small cap is where we see valuations having gone up quite rapidly due to the performance in the last year or so. So from the mid cap perspective, the long-term average is about similar 20 times, but the 1 year forward valuations are close to about 25, 26 times. Similarly, the small cap long-term averages is about 16 times, and the 1 year forward is way about 20 times. So at a broader market level, if I were to glance on equities, while we remain extremely constructive on the long-term outlook, given the fundamentals being so strong, but I think we need to have a slight bias towards large cap as well as multi-cap strategies. So we are not saying that we are not as constructive on the equity markets. We are just a little considerate of where valuations stand, especially in the mid and small cap space. We feel that by allocating to multi-cap managers, the underlying fund manager has the freedom to tactically allocate between large cap, mid cap, as well as small cap, more on a bottom-up basis, depending on what platform you choose, whether it's mutual funds, PMS, or alternate investment funds as well. And the bias towards large cap will just help tide through any interim volatility. And one thing, Niraj, that we've always learned is that even in the best of bull markets, you always see an interim correction of anywhere between 10 to 20%. So that can be around the corner any which ways. We feel that the risk reward today suggests that there can be a bias towards multi-cap as well as large cap strategies, and the long-term outlook continues to be as constructive as it was last year as well.
Ashish, coming on this, in your note, and you referred to this, of course, slightly differently, but in your note, this one of the statements at the top speaks about with the US Fed expected to start lowering interest rates, but you mentioned, correctly maybe, that it may well happen in the second half as well. And we are in the week of the Fed's peak, as so to say. If indeed the Fed dashes hopes of a March cut and maybe the market starts pricing in June or later, does it have the potential to bring down global risk appetite in global assets, because the world markets may be pricing in a March cut even now?
I think, we are not pricing in a full-fledged risk on in any case, because if you look at what's happened in the last month or so, we are anyway seeing a lot of FI selling, right? I think, we know that it's peak rates and US Fed will cut rates, but it could happen in the second half of the year because inflation continues to be extremely sticky, and US has its own compulsions. So I don't really think that has been modeled in. I mean, I don't think a risk on full-fledged. If the risk on happens, Niraj, by any chance, and if the Fed does indicate that they're going to cut rates sooner, then I think you're in for a further re-rating on valuations on India. Because just think about it, in 2021 September, which is when you saw the last peak of the Nifty. Of course, we are well above that right now. You were trading at 30 times trailing multiple. Today, you're trading at something like 22, 23 times. So is there room for a further re-rating on the Nifty? There is definitely room, but that will happen when FIs come back into the market. And I'm very clear that they will come back at some point, because if you look at it anyway, and if you look at the global construct, I think most people are underweight from what they should ideally be on India.
Yeah, that's true. But in some sense, we started to see, at least the last week or 10 days, or maybe in the month of January, a bit of a shift towards better valued markets relative to the expensive markets like India and some others. So could that be the bit of another angle which might bring about some near-term volatility? Is that possible? Just dwelling away from the note per se, but to the more immediate measures.
It's quite possible. I mean, that's why when we looked at the data and balance, we said that, this is not a year where you go, let's say, overweight. I mean, there are times, when it's clear in front of your eyes that, markets are cheap and, from here downside is very limited and, you kind of take a big bet. But that's not the case today. Today you're priced very well. So there is no room for error. Let me put it that way.
Got it. The full toss nahi hai. Okay, fair call. Just the one aspect more on equities before we talk about something else as well. Nitin, you dwell a lot on numbers, and you guys have consistently made this point that while the market may be scared around the broader end of the spectrum, but earnings growth is kind of making up for it for the large caps, maybe even for the broader end of the spectrum. Now, I was looking at your data, right, and the CAGR numbers for the small cap index for the last 3 years has been very strong as well. So if this is the kind of pace, and even if a bit of a moderation in the pace for the small cap 250 earnings growth continues, does it therefore ease the fears that the street has had for the last 3-4 months, whereas incessantly the call is that small caps are expensive and that's a place to be fearful of?
Yeah, sure. So, look, as you said, the last 3 years have been phenomenal for both the small cap as well as the mid cap. You're seeing upwards of 35 to 40% earnings growth on a compounded basis. Now, this did not happen even during the 2003 to 2007 era, right? Which is the last really long-term bull market that the Indian market saw. Now, even if we are able to keep some kind of a steady pace, what we are saying is that it is wrong to firstly look at the entire index and then take a call on mid and small caps, because there are 2-3 things, Niraj, that one needs to be concerned about. The first aspect is quality. Good management, good balance sheets, companies which consistently deliver in terms of volumes, and all the stocks represented in the index may not necessarily have those constructs, right? So valuations isn't the only aspect that we would like people to focus on. It's also the quality. The other thing is the size of opportunity. Which sectors is that company really present in? Is that sector having a great growth profile over the next 3 to 5 years? Is that pool expanding? And I think these are the factors that will go in to a fund manager really allocating, or to investors really allocating into mid and small cap space. While the large cap is a far more easier call, relatively speaking, as more passive. You can pretty much look at the index and then take a call because it's a handful of companies. But once you get into the small cap space, which is like 250 odd companies, I think the call there has to be far more selective. It typically is more on a bottom-up basis.
I mean, mid and small cap stock selection will play a greater role, Niraj. I mean, so far it was a beta market, right? Whatever you touched has gone up.
Yeah. Well, and which is a great place for funds and stock pickers to come out and maybe even outperform, because accidents will happen, and it is only when the right stocks are picked in the portfolios that things will do well. Okay, just before we take that break, though, I know we need to slip into one, but just one quick word. I didn't, maybe I missed it, but I didn't see that slide which speaks about whether we are in this amber zone or green zone, which typically comes, right? So on the sentiment indicator, maybe I missed it, but what is that indicating this time around?
Yeah, we are still in fair valuation zone as far as the Nifty is concerned, and we still have a long way to go before we touch the expense.
Okay, music to the ears. Gentlemen, stay on. We need to slip into a quick break. Television compulsions. We come back and talk about the other end of the market, because it's, as they say, that it's a year of the all-rounder. So can't talk only equities. We talk about fixed income and we talk about gold on the other side of this break. Viewers, stay tuned. All right, back with the conversation on Alpha Strategist, a note that comes in from Motilal Oswal Wealth monthly, and they speak to us on that. We've spoken in the previous segment about equities. We got about 6 minutes to try and talk about fixed income and gold, which they are constructive on in the year of the all-rounder in cricketing parlance. Gentlemen, fixed income. Now, what is anticipated? It's a year of potential rate cuts. Maybe the RBI does a lot on liquidity in the first half, as opposed to tinkering as much with repo immediately, considering that the global markets and the global banks might also be singing a different tune, who knows. So how do fixed income investors approach the next 6 to 12 months?
Right. So let me give you a little bit of a perspective, and also we'll dip a little bit into portfolio construction, which are the modes for investors to really enter into to build a portfolio over the next 3 to 5 years.
Sure.
So the first aspect is that I think irrespective of what the Fed may do, the RBI will be far more watchful. We do not at a domestic level have the level of inflation concerns that the global markets are going to. But the RBI will keep an eye on the interest rate differential between what our repo is vis-a-vis the US Fed. Also remember that from a 10-year perspective, if you look at the US 10-year and the domestic 10-year GSEC, the difference now is just about 350 basis points, right? Which is the lowest that it has been for quite a long period of time. And when that happens, typically you do not want that differential to be far too narrow, because to that extent your currency can also be impacted. So even if we see that the US Fed may cut over the course of this calendar year, I think the RBI will keep a slightly more calibrated approach to how it behaves with its domestic interest rates. And you touched upon a very valid aspect that if you add more liquidity into the system, that by itself can demonstrate a 25 bips rate cut, right? So today the yield curve as it is extremely flat. All the way from the 1 year to the 10 year, you're trading at about 7%. Our outlook over the next 2 to 3 years is that this curve should dip lower and it should also steepen, which is basically to say that the shorter end, the 1 to 3 year segment should ease off faster than the 10 year, right? But we do see that the current 10 year, which is around the 7.2% mark, at a terminal rate over the course of this easing cycle, can go maybe to the 6.75, 6.7 odd percent, right? And hence, given the fact that India has also been included in the JP Morgan Global Emerging Market Index, is when we actually put out that call of saying that people should participate into the 10-year GSEC, either directly or even through funds, because you earn a combination of accrual, 7%, plus any potential capital gains that may come along. Now, there are 2-3 other points within the fixed income portfolio that investors should take notice of. One is multi-asset funds, and there is a category which is between the 35% equity to 65% equity, and there are certain multi-asset funds which operate in that space. Those funds which have relatively lower exposure to equity can be looked at because they can still give you an indexation benefit if you hold them for more than 3 years, right? So you get a combination of equity, fixed income, as well as gold. And having a correlation of different assets can really help the portfolio. Apart from that, there is one other category, which is REITs, real estate investment trusts. Mm-hmm. And we believe that, that offers investors an ability to participate into the commercial real estate market without having to, engage in that kind of high ticket size. The real estate sector has progressed fairly well over the last 2-3 years, especially post the pandemic. And at least within the top 7 to 8 cities in India, we are seeing volumes rise, effectively with a lot of corporates asking their employees to come back to work as against the earlier work from home culture. We do see that the current tailwinds to the residential real estate sector will translate themselves to the commercial real estate sector also over a period of time. And hence a REIT, is a great asset to own because it's a hybrid fixed income instrument. It offers you steady cash flows. and over a 3 to 5 year period can offer you capital appreciation as the commercial real estate market gets a steady outlook. So these are multiple ways in which you can participate and construct your entire fixed income portfolio, and at the periphery also avail of some of these private credit funds and high yield funds.
Ashish, you want to add something to that, and then also a flavor on gold, because you've mentioned to us earlier in the show that gold looks attractive to you.
So just to add to what Nitin said, I don't think our view is that interest rates will get cut sharply, because India has always been a moderate inflation country. So we don't expect inflation to come up very, very sharply, and I don't think we hold that view even for a country like US. I think for a prolonged period of time, we are in for a moderate inflation kind of a era. But yes, over the next 2 to 3 years, there is a tactical opportunity that rates will come up based on the factors that Nitin just highlighted, and one can definitely participate in it. Coming to gold, I think, the call is based on 2-3 points. One is there are a lot of these geopolitical issues around us. Now, I understand that the market is currently, from time to time, the markets do get concerned, but has largely now ignored and moved on. But one cannot deny the fact that any one of these geopolitical issues can flare up at some point in time. So gold is like a protection against these kind of incidences, and it gives you firepower at that point in time. Typically when geopolitical issues flare up, you have equity markets falling, it's a risk off, and something like a gold tends to move up. And that's a great opportunity for you to take some money off gold and rebalance into risk asset classes. Second is, as interest rates go lower globally, and there are currency shifts as well which are happening. Gold clearly comes out as a asset class which is agnostic to currency, and hence we believe that the next so gold is a more structural call, Niraj. I mean, next 2 to 3 years, 4 years, we feel gold as an asset class should do well, and hence we are advocating that at least between 5 to 15%, depending on what is the total construct of the portfolio, you can have in gold. And in India, you can participate through SGBs, which gives you tax-free returns, or you can participate through some of these ETFs or index funds which have gold as an underlying. So that broadly sums up our view. And just to kind of end with a cricketing parlance, I think we are going into a pitch which is neither a straight batting wicket or outright bowling wicket, right? There is something in it for everybody. So I think that's the kind of pitch we are looking at this calendar year. Yeah. And hence having a bit of all asset classes is a good idea. Yeah. And through the course of the year, hopefully clarity will emerge.
Yeah, pardon me for sounding an out-and-out Mumbaikar, but something like a Wankhede pitch, if you will. But appreciate these views. Gentlemen, both of you, thank you for laying it out, what the year could mean. The year of the all-rounder, I think this is very valuable for people to know and understand. Please do dig in deep into this and try and think about this when you're thinking about your portfolio building construct for the next 12 months, maybe even longer. Thanks so much, Nitin, as well as Ashish, for talking to us today. And viewers, thank you. And viewers, thanks for tuning in.